Hey, welcome back, everybody, to the FourStar Wealth Today's Market Explained podcast and video series. We do market commentaries and we also do interviews. And this is one of our interview episodes, and we're welcoming back to our broadcast the famous Barone team out of the Reno operation of Universal Value Advisors, and they're also FourStar affiliates, Bob and Josh Barone. Bob and Josh, welcome to the podcast today.
Good to be here.
Thanks for having us.
Glad you could make it. And along with me in the questioning, interrogation, whatever we want to call it, is Jack Walsh. And Jack is a FourStar advisor, works with the FourStar practice. He's also an experienced trader on the floor for many, many years. And we call him, his nom de guerre is Trader Jack. Welcome.
Thanks, Brian. Happy to be here.
Excellent. Well, good. Well, Bob and Josh are very experienced investment advisors and also economists. So Bob is former economist at many levels, former chairman of the Federal Home Loan Bank of San Francisco. He's a Forbes columnist, so much of the work that Bob writes appears in Forbes. And Josh also is a very experienced economist and one of the lead portfolio managers at Universal Value Advisors. So we're very pleased to have you guys. Thanks, guys, for joining. And Bob, do you want to give us like a little overview? You know, we think it's a tough economy. We're not really sure, right? It's very confusing.
Well, it has been confusing because Wall Street, many on Wall Street refuse to believe we're going to have a recession, but we are. We're going to have a recession because for the first time, at least in my long lifetime, the Fed has raised interest rates into a recession. And we have a phenomenon where because of that, we have the bond market declining. And at the same time, because we're going into a recession, the stock market's declining. And so folks who manage portfolios are scratching their heads and saying, where do we go? But it's pretty clear that, you know, the first industry that is impacted by higher interest rates is housing. And housing has just been really down. Last month, the housing starts fell 8%, and they're down over the last few months at a 40% annual rate. That's huge. Those are big numbers. And the Fed seems to have ignored the deterioration in the housing market and in all the interest-sensitive markets. For example, we see that consumer borrowing is up at a huge annual rate, and that's because consumers, when you go to fill up your gas tank and it costs you twice as much as it used to, they put it on their credit card. And now banks are, when they report, they're reporting that their loan loss reserves are being increased because they expect over the next few months that they're going to have issues with delinquencies. We've also seen corporate issues where corporations are having less liquidity, and they're going to have issues too. So the Fed at first said, well, we're going to have a 4% economy in 2022. Well, it's almost the end of 2022 and we're not anywhere near 4%. And so at their last meeting, they lowered it to 0.1%. That's the Fed's way of saying, yeah, we know a recession's coming. Over the last few days, so the Fed has been increasing interest rates at a very high rate, higher than, faster than at any time over the last few years, maybe over the last 40 years since Volcker. And they've been increasing these interest rates quite rapidly and seemingly ignoring what's going on in the economy. And all of this time is different in the sense that this is the first recession that we're going to have where the Fed has a new policy called transparency. In the past, let's say, when Greenspan was the chair, nobody on the Federal Open Market Committee, that's the rate setting committee, ever talked about what they were going to do or what they were planning to do. They were always silent. Beginning with Bernanke and in 2012, they started publishing the thing called the dot plot. This is where they all forecast where they think interest rates are going to be over the next 2 or 3 years. And the market takes the dot plot as gospel, even though the history of the dot plot since 2012 is that it's about 37% accurate. So it's not really very accurate. Despite that, the markets take that as gospel. And so when any of those FOMC members say, hey, we're going to tighten further, the market reacts instantly and puts interest rates to where they think the Fed is thinking, not to where the Fed is, but where they're thinking. So we had last week on Friday, a Wall Street Journal article came out. Now the Fed has its favorite people where it kind of leaks information to them. And the fellow at the Wall Street Journal published the article saying the Fed is now thinking of not raising interest rates as fast as the market thinks. So we had over Friday and Monday and Tuesday, interest rates came down significantly from where they were. The 2-year was over 460, and now it's back to 440. So there is now, and Mary Daly, who earlier in the week, Mary Daly is the San Francisco Fed president. Earlier in the week, Mary Daly said, hey, expect us to move rates higher and keep them there for longer. Early in the week, she said that. And by the end of the week, she said, no, we're thinking about not raising as fast. Mm-hmm. Now, let's be clear. This isn't a pivot where they're reducing rates, and it's not a pause where they're stopping. So it's the next best thing called a step down.
Step down.
And as a result of the fact that markets have in this cycle have instantly moved to where they think the Fed was going. Now that the Fed is saying we're really not going there, the bond market has eased off a little bit.
Okay.
So interest rate sensitive sectors like housing are in the tank. We've seen retail sales on a real basis, this after inflation, being flat to down. And even though we are probably going to have a positive GDP print this tomorrow or Friday, mm-hmm. It's technical in nature. It's due to the foreign the strength of the dollar and imports and exports, net exports, and to the fact that corporations, because they were afraid of the supply chain issues, ordered inventory because they didn't think they were going to get it, and now they've all gotten it, and they don't really want it. So we're going to have an inventory increase that's unwanted, but it's going to show up as a positive in the GDP. Nevertheless, the economy is weakening, and I think the Fed is starting to recognize this.
So, Bob, do you think that all this discussion, dot plots, meetings, speeches after every move is causing more problems, volatility, things that shouldn't be happening?
Certainly it is. I mean, we've never seen such volatile fixed income markets. And now even in the equity markets, we've had like 34 days in 2022 where the Dow has been up 400 points or more, and yet the Dow is still down 5,500 points, from the beginning of the year. So that's kind of bear market. In bull markets, we see 400-point days once or twice a year.
Well, yeah, it's certainly frustrating. So we're in a recession, but it looks like it's going worse. that's the message. Josh, any follow-up thoughts on that?
Well, just the volatility of the treasury market and the direction. So, we all know that everything prices off the treasury curve. And there's been so much volatility in the treasury curve this year that it's really hard to get a direction. And, to add to that, when Bernanke made the Fed transparent, now we all like transparent things, but maybe the Fed shouldn't be transparent. And because what used to happen is that they would inch up and the market would follow. They would inch up, the market would follow. Me and Jack would be guessing on what would happen by the size of the briefcase that Alan Greenspan was carrying into the meeting. But with what happened is with the invention of the dot plot and essentially transparency in the Fed, they broke their tool. And so now they're out. One, you get volatility in the treasury markets because the treasury market is looking at the dot plot saying 2 years, even though the spread of where they think they're going to be is really wide, is still trying to discount that. And so you get these volatile days. And so what happens is for the Fed to actually make their tool to work, hey guys, we're raising because we're trying to break inflation. Stop trying to discount us 2 years forward. They've gotten really hawkish. And I don't think we've ever seen a Fed speak so much. I think, every member, voting member and non-voting member is literally in the market every week speaking. And that hasn't helped as well. But they've had to do that to keep rates high to get the effect that the desired effect to bring, whether you think it's transitory inflation or embedded inflation, to bring inflation back down. And again, it's a real problem. And it's a real problem long term because you start questioning the positioning of the reserve currency status. You don't want your treasury market volatile at all if you're the reserve currency, because then people, they take losses. People don't like losses. Countries don't like losses. And when you're reserve currency, you're looking for that stability. So with transparency, and I can show you a chart that it shows that it's 100% correlative with what their action. You created volatility in the market, and again, long term from a patriot standpoint, it's not something that you want. And so it's a problem. The question is whether they can fix it, or is this the new mantra where they just are talking all the time, and it'll take a couple cycles for the markets to get used to it.
Yeah, it's quite a different trend now than the way it used to be. And I remember those days of the size of the briefcase, the beige book indicator, all those other things that went on. And now it's all out there for everyone to dissect, and they may not even understand half of it, but they're making moves and deciding what to do, and it's creating volatility. So
one other thing, Ryan, is that this particular Fed seems to be fixated on lagging indicators. Mm-hmm. So, for example, the 2% inflation rate that they want, they're looking backwards at a year-over-year indicator. So it was 9.1, then it was 8.3, and now it's 8.2. But that's year over year. If they look at the last 2 or 3 months, it's near zero. Okay. Mm-hmm. So why is that? Well, that's because we've had easing in the supply chains, and so we still have inflation, but it's not anywhere near 8%. Mm-hmm. And then they look at their favorite is the labor market. Okay, so they look at what's going on in the payroll survey. Mm-hmm. Now, of all the surveys, and we've written about this, of all the surveys, the payroll survey is so biased and flawed. So, for example, in today's payroll survey, the difference between the not seasonally adjusted and the seasonally adjusted numbers are over 1 million jobs. Okay? Well, what is seasonal adjustment? Seasonal adjustment is things like, well, we know Christmas is coming and sales go up, so we adjust for some normalcy. But the rule is that at the end of the year, the not seasonally adjusted and the seasonally adjusted data have to be equal, because the seasonal is just for the year, within the year. Mm-hmm. So we have more than 1 million of the 3.5 million jobs, more than 1 million of them are from the seasonal adjustment factors. Then we have something called the birth-death model.
Mm-hmm.
This has added almost 1 million jobs to the payroll survey this year. Now, what is the birth-death model? The Bureau of Labor Statistics does not survey small business. It only surveys medium-sized and large businesses. And because of that, several decades ago, 2 or 3 decades ago, the political forces said, hey, it's not fair. We know that small business is the heart of America and small business grows. And that's true. But small business doesn't grow in a recession. Nevertheless, so what the BLS does is it has a time study in which it says small business grows, and so it plugs in a number that it doesn't survey. It's just a plugged number based upon this time survey. And this year, it's been almost 1 million jobs that they've plugged. So with the seasonal factors and with the birth-death model, we have about 2 million jobs that simply have been created out of thin air. Now, there was an article in the Investment Business Daily last week. And in that article, it said that it went back to look at the seasonal factors from 2018, 2019. I think they skipped 2020 because of the pandemic, and in 2021. And they found that the payrolls were reduced by 465,000 in 2018, by 533,000 in 2019, and by 709,000 in 2021, because the seasonal factors were at play. So the seasonal factors have to be negative for October, November, and December. Okay, well, one of the other things that the BLS does is every month it adjusts all of the data back to January because it changes the seasonal factors. I don't know why, it's crazy, but every month all the seasonal factors change. So there's adjustments going back all the way to January. Mm-hmm. But the BLS won't tell the public what those adjustments were, just for what they were last month. And in a footnote, they say, we don't want to confuse the public.
Okay.
Yeah. So we don't know what they've already adjusted, and we won't know that until they release that data, which is in February of each year. Mm-hmm. So it could be that they've already adjusted backwards and taken some of the jobs out, but we don't know that. Mm-hmm. Or it could be that the Investment Business Daily article is correct, and we're going to see big negative seasonal adjustment factors in October, in November, and December. And if that's the case, if the Investment Business Daily is correct, then we're going to have a very weak jobs report here in November. Unfortunately, the Fed meets this time in November on the 1st and the 2nd, and the jobs report doesn't come out until the 4th. Mm-hmm. I don't know if they're privy to it or not, but it seems to me that they're pretty locked in to their 75 basis point rate hike. And perhaps that's why they put out to the Fed whisperer at the Wall Street Journal that maybe they're not going to be so uber hawkish going forward.
So they've been very hawkish, and eventually it's going to stop. And you had a piece you talked about, did the Fed just blink on markets? That was also appeared in Forbes. So do you think that, Bob? Do you think the Fed did blink?
I think they're blinking, yes. I think that we're going to see, and we saw that in the Bank of Canada today. Mm-hmm. The Bank of Canada was expected to raise interest rates 75 basis points. They only raised them 50, and they talked about the fact that they think they're going to have a recession. Now, our guys can't say recession. I don't know why, but they won't.
It's election season.
Yeah.
So, well, we'll see. So let's see what the Fed does in November, see if they take a little bit of pressure off the gas pedal. But they've been forging ahead as aggressively as they can, and it's creating a lot of issues, isn't it?
Yes.
So one of those issues is all the explosions that are going on in the economy. We've seen China, we've seen the Bank of Japan, the Bank of England currency almost explode, Credit Suisse and the Swiss requiring money, all kinds of things going on. Josh, you know a little bit about all those explosions, don't you?
Yeah, so you saw, I think it started with the Bank of England having to go in and essentially protect its currency, bring rates back in. And the way they do that is they typically sell treasuries that they hold, and then they go buy gilts. So you've seen that action happening in the Bank of England. You're also seeing the same action happen in the Bank of Japan. And I think there was a re-peg of the Chinese currency as well. So you're seeing a lot of actions, and again, it's essentially that the dollar is really, really strong because of the Fed actions against everybody else. And as that's gone on, you're seeing, and especially you have this massive inflation in Europe of energy, right? Essentially Nord 1 and Nord 2 being blown up, right. and Russia, boycotting, all of Europe. And so you have high inflation now, not the same as like employment inflation, but high inflation from this energy shock, and you're getting high dollars, and so you're having these actions, and you're seeing the Fed having to protect them. I think we were talking about this a long time ago, maybe 6-7 months ago, how we thought the Fed would have to come in and support their markets. The ECB is another one. I mean, very interesting. You saw Italian bonds blow out, and so they were selling bonds and buying the Italian lira bonds and to bring those rates back in. Subsequently, you've seen the euro. I mean, went from like 107, 110 down to 98, and I think before all this is said and done, you're going to see it lower. Europe still doesn't know how to heat itself over the winter. It might have some stores, but it's really, dependent on the rest of the world, really U.S. right now. I think a lot of their natural gas stocks are coming from U.S. LNG, which is funny because when we shut our LNG ports, natural gas prices in the U.S. go down because there's an abundance of it. But when we open those ports up, then there's pricing pressures coming from Europe. Yeah. LNG is interesting because it's not the easiest thing to move around. And ships don't just create themselves overnight. So the LNG run prior to the Russian invasion the best run was Australia to Japan. That's where you would make the most money. You're seeing that Japan's had to flip back to nuclear because the LNG is too expensive because there's so much demand for it in Europe. Fed tightening on all this stuff does not help. We'll see if they do 75 here on the 2nd, what that does to foreign markets. I'm sure there'll have to be massive interventions from central banks to counter that. But we'll see. I mean, the dollar has backed off a little bit, but with this Fed being so hawkish, so worried about inflation that, again, we view as somewhat transitory in this country. I just don't think that they're going to back off here anytime soon. And again, they're not going to do anything before a political election because they can't be seen as partisan, although they seem like they are a little bit partisan too when we look at them.
We have 2 weeks until that's over with now, the election, right, Josh?
Yeah. So again, I think if there was no election, you might only see 50 basis points out of the Fed. But since there is, I think that 75 is baked in. They're not going to come off of that. You're really seeing Daly out there trying to say there's problems going, and you're seeing Janet Yellen saying there's liquidity problems in the treasury markets. Now, I haven't seen the liquidity problems show up in our treasury markets yet, but foreign holders of treasuries are down to 2018 levels, and so there's got to be some pressure on that market to do things. I kind of scoff at when I hear her say that she's going to do buybacks, because essentially what you're doing is issuing bonds to buy back bonds, and it seems kind of, I don't know how to even say it. It seems kind of strange.
Counterproductive, yeah.
Yeah, you're not really doing anything, essentially targeting maybe a spectrum of the bond curve. Yeah. And at this point, you're probably buying higher. You're selling higher coupon bonds to buy back lower coupon bonds. Doesn't seem super smart, but again, the beauty of central banking is you do the opposite of what a normal banker would do, and that's how they operate.
Yeah. So there's been more explosions too, right? There was a rumor that Credit Suisse was going to fail, and then they denied it, but then all of a sudden money is moving over to Switzerland, right?
Yeah, I mean, you saw the credit default spreads shoot out massively to Lehman levels on credit. Deutsche Bank and Credit Suisse, both of them. And so it looked like they have massive problems. And it makes sense. Essentially, they're holding bad paper in the terms of ECB constituent paper. Let's be honest. Does the Italian yield level deserve to be where it's at? Not when I look at their economy and their debt levels. No, it should be much, much higher. And so, that the ECB conglomerate has allowed that to happen as they manipulate the bonds of the constituents. Now, essentially, the ECB becomes a bad bank because they have to buy all the poor paper and sell all the good paper, the German paper. And again, this is kind of why the monetary union was devised in the first place, to essentially import the southern countries' deflation into Germany so they could mass produce and be competitive worldwide. Now, there may be a little bit of conspiracy theory out there, but my view is that's spot on.
Mm-hmm. Well, and I know Sky News was reporting in London that as many as 25% of the citizens of London are going to be probably staying overnight in shelters instead of their own home. And you were talking earlier about Germany, where they can't figure out how to heat their homes now. And so all this aversion from fossil fuels has now created a situation where we don't have enough and we don't have an alternative. And then we're in big trouble in Europe. It's really hurting everything, isn't it?
Exactly it. I mean, so inflation is kind of a nasty world that is really broad. There's all kinds of different inflation, okay? And so what Europe has is energy shock inflation. It's kind of, in the 70s, we had that here. If you were alive back then, you waited in line for gas to put in your, Monte Carlo that only got 7 miles to the gallon, right? And then we brought out efficient cars, et cetera, et cetera. But again, so they're experiencing an energy shock. And again, it's in inflation. They're trying to fight it the wrong way, in my opinion. Raising rates into an energy shock inflation isn't all that proper. You probably should maintain a steady line and deal with your energy problem, whether that's bringing nuclear plants online, doing a deal with Russia, which is inevitable anyway. Again, it's not a country where the sanctions that the G7 and the United States are putting on work. All you've done is increase the price while oil's leaked out the back through China. And so the supplies there, you've helped that country essentially by bringing the prices up so that the oil, even at a discounted price, is worth more. So that hasn't worked. But going back to the energy, so essentially their economies are shutting down. If you look at the new car production coming out of Germany, it's at a standstill. They can't afford the energy to run the plant to keep the car manufacturing and the end price of the car competitive. So you're better off shutting down the plant. Plus, if you don't have the energy to keep your citizens' houses heat and power on, you're going to turn off your big consumers of power,
right.
Car production, manufacturing. So their economies, they haven't cratered yet, but they're going to, as they don't have enough natural gas storage to make it through the winter. And next winter is being predicted to be worse if the current situation maintains.
They got to change their equation there, maybe nuclear, maybe use fossil fuels, even though they claim they don't want to, or do something. They've got to do something.
I don't have the answer there. I don't. The short-term answer is you have to do. They kind of have to go to Russia and pull in gas, and you can see Turkey positioning itself to be that gas hub. Again, kind of strange, but they are Turkey being a NATO country, But that also brings problems in NATO because those sanctions need a unanimous vote to pass. And so figure the EU sanctions will fall off. I think they have to be revoted in early December. So as soon as those sanctions fall off, everybody in the EU is going to cheat. And maybe that helps the problem a little bit, but we'll see. Then you start getting into the question of who blew up Nord 1 and Nord 2, American helicopters being in the area. It seems fairly interesting. And then the talk of a dirty bomb being used in Ukraine, and with the whole dirty bomb in Ukraine thing scares me because it's being set up that, hey, if these Ukrainian forces do it, it's still a Russian action. It's a lot of propaganda going back and forth, and I have a hard time reading what was actually the truth. Let's just hope nobody actually uses one, because from a humanity standpoint, that's not a great action to take.
Not a good thing. Well, and Jack, we had some adventures in the metals markets. Did you have some questions about metal?
Yeah, I did, Brian. Basically, Josh, earlier in the year, you were looking at the nickel market, and we would just like to talk a little bit about the COMEX and the London-based metals exchange, and what type of problems that they might be experiencing. I believe that if you have your currency, whether it be the pound or the euro, and you're a citizen, and it continues to depreciate, and you have inflation issues, that you might want to go to a precious metal, possibly gold and silver. Do you have any thoughts on that type of idea?
Well, I think you're dead on right. I think that gold is just talk about gold for a second, then I'll get into the metal markets. Gold is interesting because as the Fed is actually winning in the U.S. against inflation, gold is typically thought as an inflation hedge, and so you would want to be a seller. But what you're seeing is governments buying it. Chinese governments, the Russian governments are all stockpiling gold as there's essentially a war between resource countries and trading countries. It's a good underpin for societies, governments to prop up their currencies a little bit. And you're seeing that's a problem. So maybe if you're the Bank of England, instead of operating in gilts, you start buying gold reserves too. And you haven't seen that in the Bank of England yet because they're just doing these simple operations. But long term, it does look like you're having some demand from governments. Now, let's talk about the nickel market, because I think that the nickel market, when this guy shorted nickel and created this huge short squeeze in nickel, I think it really broke the London metals exchange. I think that is severely flawed after that nickel trade. So just get into the basics of it. There's a guy in China. He has a ton of low grade nickel. Nickel is an alloy metal, so his is low grade. You have to add another metal, and he could bring it up to high grade. But essentially, he has the metal. Okay, so he's shorting against his own position, and he has a huge billion dollar, large multi-billion dollar short position. Well, markets got a hold of that, and markets do what they do, and they squeezed it out. It shot the nickel prices through the roof. I think they did that to silver. The Koch brothers did that to silver back in the early 80s. But it happened in the nickel market. And so the London market exchange's reaction to that was to cancel trades. So essentially, people are making money as the price is going up, and so you look at your account at the end of the day, you thought you made, say, 100,000, and then the London market said, well, you know what, there was too much volatility in the market, so we're just going to cancel that. That didn't happen. Your trade went away, and I think that's what broke that market. And now it's becoming questionable as commodities have been bouncing around here as well. Whether that they can, I think you were talking about whether they can actually settle trades in delivery anymore of metals that they claim they have, copper, gold, silver. And so the legitimacy of the London Market Exchange has become very questionable, whether they do have it. And that's kind of where you are. So if you're trading on the London Metals Exchange for delivery, you don't know if you're going to get your metal or not. And so you have a problem in that market. And again, all brought on by the action of canceling trades, whether, you know, they can actually secure anything. Now, I want to say, if you remember, a few years prior to, they were involved in a price fixing scandal with several banks as well. I think they were price fixing the price of gold and silver. So, I mean, if I'm doing business, I'd rather probably be on the CME than operating in the LME at this point.
Interesting. Yeah, and then the other thing I would like to hear from both you and Bob is that we had this cycle of rising rates, and Josh, for a long time, you were talking about the strong dollar, rising U.S. rates, strong dollar, rising rates, stronger dollar, and it seems to really put the world in a bad situation. Now, Bob said earlier that it looks like the Fed blinked, and we saw out of the Bank of Canada, you know, the market was expecting 75, and they only did 50. So if you guys were central bankers, right, and you saw this self-fulfilling, talking higher rates, higher dollar, causing problems for places like Credit Suisse and other countries, what would you do at the upcoming meeting, and how would you kind of soft shoe it so that markets at least settle down for a short?
So let me jump in front of Bob here, and then I'll let Bob finish the question. So in the 70s, when Volcker was fighting inflation, when he saw the forward indicators roll, he started to roll interest rates as well. This Fed doesn't operate the same way the Volcker Fed does. The front end part of the curve and forward inflation looks tame at this point, and yet they're still talking about raising rates, hawkishness, and problems with inflation. I think Bob touched on that. They're kind of backwards looking, but I'll let him finish the question and give you the detail that I don't have.
Bob,
So can you kind of...
Yeah, Bob, I was just saying, let's just pretend that you're at the Fed now, and you've seen all of the problems that the strong dollar, high interest rates, not very liquid U.S. Treasury market. You saw the article from the Wall Street Journal. What would you do on November 1st and 2nd to just try and calm things down?
Yeah, so the Fed has boxed themselves into a corner, and they don't really, they don't want to lose credibility, because if they don't do what they've been preaching, they lose credibility. So that's why they did the leak to the whisper at the Fed to say, hey, maybe we're going to step down, and that's why the FOMC members, Mary Daly in particular, and I think there was one other one, talked about, hey, maybe we're going to step down and not raise to where we thought we were going to raise. So I think the Fed has a credibility issue. They can't come out and say, oh, we over tightened and now we've got to reverse it, because then they lose credibility. So it's half of the issue is political. The other half is what they look at for their for what they're trying to do. What they look at, they're looking at backward lagging indicators. As I said before, the year-over-year inflation rate is 8.2%, but the 2-month inflation rate is 0. So we've already come through the worst part of the inflation. Was the inflation transitory? My answer is yes, it was. The problem was when they said the word transitory, they meant 2 months. The real transitory part of the inflation is probably 18 months to 24 months, and we're halfway through it. So we will, if they don't do anything from here on out, we'll be done with the inflation the end of next year.
Right.
because the supply chains have opened up. We've seen things like the cost of moving a container down about 81% over the last year. It was like $2,300 to move a container from China to the West Coast, and now it's $300 or $400. So the supply chains have eased up. In fact, in all of the Fed regional bank surveys, the issues of supply chain, these are backlogs and vendor delivery times, are all back to normal. And so most of the supply chain issues are behind us. There's still a few of them, but most of them are behind us. And so if they just left it alone, inflation would come down on its own. So they've raised interest rates now. And what does that do? Okay, it can't do anything to supply. No matter how high the Fed raises interest rates, it doesn't produce another barrel of oil.
Right.
Okay, but what it does is impacts demand. So they raise interest rates really high. For example, the housing market, interest rates, the 30-year fixed rate was 3% at the beginning of the year. Now it's 7%. And what we've seen is a really rapid deterioration in the housing industry. Well, that occurs probably not as fast, but in the rest of the economy that occurs. And so when they raise interest rates like they have, the impacts take a long time to reveal themselves in the marketplace. And so even if they don't do anything from here on out, we're going to still have impacts from what they've already done. But they are going to raise 75 basis points in November because they said they would. And they can't afford, they think in their minds, they can't afford to lose credibility. So they're going to raise 75. After that, I'm not so sure. If they only raise 50 in December, that's probably what they're going to do. But it could be that they only raise 25 or maybe none. If they didn't raise any, then we'll see if they only raise 25 or zero in December, we will see a huge rally in the bond markets and probably in the stock markets too.
Yeah.
Right. Well, it seems to me like, even though we know from being in the markets that the Fed doesn't want to be political, it seems like they're setting themselves up to take a lot of heat either way, right? I mean, it seems to me that if they do throw the economy into a recession and we see those unemployment numbers jump the way I think you and I suspect, that they are going to take a lot of heat. So,
yeah.
And don't forget that he didn't want to appoint him last time. Remember how long it took him to reappoint Powell to the Fed last time? So he can come out and say, well, I didn't want to appoint him anyway. And look, he crashed the economy. It's not my fault, right? So they are set up to be the lightning rod of the, this election or the next coming one after this. So especially if things don't improve in the next 2 years.
There's a lot of finger pointing going on around, isn't there?
Yeah. I also want to note that rents have rolled over just recently in the last 2 months. Now, I think we've been talking to people and doing private equity deals, especially that were, apartments. I always said, well, what happens when rents rolled over? The answer was like, we don't see that. So rents finally are starting to roll over. What's funny about the core CPI, the way they calculate rents is really ridiculous. And this is how they do it. You're a homeowner. They call you in a survey. They say, if you were going to rent your primary residence, what would you rent it at? And then that's how. And then they group those together, and they they give you a delta off that, and that's what they put into the core CPI. If you look at where the core CPI has been hot, that's where it's been hot. A little ridiculous, in fact. And so now, but again, that's caught up, and now rents look like they're rolling over. Apartment rents are looking like they're rolling over, and that was, one of the hot spots in the core. So things are rolling over rapidly, and again, like I said, the Volcker Fed saw that, started to react to it. This Fed is not, and so again, the question is, how deep of a recession do they put us in, and what the duration of that recession is going to look like? it looks like from our perspective, we're going to a relatively deep recession. The duration is somewhat questionable because of the behavioral mechanism of the Fed now. Again, so if the Fed changes and then the bond market reacts rapidly, like you've seen it do the opposite way this year, then maybe the duration's a little bit shorter. It's really questionable. I don't know it's a little bit of guessing game on that part because, again, the Fed has never been this transparent before.
Yeah. So we're gonna have a deepening recession. We'll just see how far the Fed goes with it. If they've already gone too far, if they're blinking soon, we'll find that all out in the next couple of weeks, right?
Yes, we will.
Yeah. Hey guys, let's switch gears a little bit. I know that there's a big concern about China, and China has made it very clear that America is their number one competitor. President Xi was just elected to a third term, vowing to become the world leader in the economy and the dominant political leader in the world and overtake America. And I know that China's been sprinkling money all through countries all around the world. And once there's Chinese money in there, then there's control and they have debts. And so they're doing that around the world. They're also repackaging oil from Russia and reselling oil and making tons of profits. What do you guys think about our economy and how it's affecting our ability to fend off China from becoming the dominant world economy?
So when you look at China, especially Xi getting reelected and then having his former protege or the former prime minister ejected from the conference, that's fairly interesting, right? You don't see that kind of antics in global politics that much. You also saw that they changed their view of the Taiwanese constitution at that meeting. So if you were a military strategist, you would say that's opening up the door for them to invade Taiwan relatively soon being less than 5 years. And so it's fairly interesting in that they're doing that. Now, when you talk about repackaging oil, if you looked at their GDP that they put on hold but recently put out, they were importing lots of Malaysian oil. In fact, they imported double what Malaysia exported. So where did the excess come from? And so a lot of what I've heard is that they're importing Russian oil and then either transferring it on ships and with different origins, different flag ships, and then moving it throughout the world, or just piping it into China and just saying, hey, it's Malaysian oil, here you go. I find it interesting that our president came out and said he basically put a floor in the oil market of $70, that they would repurchase oil for the SPR at $70. Well, when oil gets to $70, whose oil do you think that we're going to be purchasing? It's probably Russian oil that stamp Chinese or stamp Malaysian, right? It's funny, but it's not. And instead of just opening up pipelines and finding our own reserves, the president's talking to Iran and Venezuela. I mean, these are regimes that are completely unhumanitarian. It's not the people that we want to be doing business with, but it seems like they're desperate and desperate not to do what they should do, which is develop our own reserves. So from a Chinese dominant standpoint, I mean, we've really been, our economy's really run up in the last 20 years based on exporting our manufacturing to them because they could do it cheaper. They had cheap cost of labor, right? It's a slave trade, essentially. They could do it cheaper and it was cheaper to ship, so then we did it. So, and that was deflationary. So we imported all that global deflation and it's allowed the Fed to print money and bring interest rates down and do all these things that they've done because of the global geopolitics of deflation. Now, I don't think from a global politics standpoint, we're out of deflation. This looks like it's an energy-derived inflationary short period, and then we'll go back to that deflation. But that means that relationships with China improve at some point. Maybe not with this administration, but maybe the next. I mean, let's face it, they do create the world's, they are the world's engine of manufacturing at this point, and they know that, and they're leveraging that against us. And it's somewhat of a problem, but let's be honest, do you think that you can import all that manufacturing back to the US and still be cost competitive? I don't think that that's doable anymore. Again, and that's somewhat what NAFTA is about, right? Exporting manufacturing to other countries that are geopolitically close, and then bringing back the goods because their labor prices are cheaper, because they're non-union, you name it, they don't have the same building regs that we do. I mean, America's kind of a high-cost place to do business at this point because of all the regulations. And again, I'm not knocking, I love America, I'm not knocking it, but it's kind of what we've created. And so there'll have to be some kind of rollback there. Watch the chip industry, because it's somewhat important of what, and is kind of forefront of what's happening in that relationship. Again, America engineers all the chip, designs them all, and China and Taiwan produces them all. And there's a reason, and it has to do with cost of rejiggering a factory. So in the chip industry, there's something called Moore's Law. Essentially, chips are getting faster and smaller. Well, every time a chip gets smaller, guess what you have to do to your factory? You have to get better air quality, because you can't have stuff floating around, and you have to remachine the whole factory. Very easy to do in China. I think if you watch the Tesla factory going up, something that took here in Reno, so some intimate knowledge of it, 3-4 years to build, they built the same thing in 6 months in China. And so, I mean, and it's a duplicate factory. They use the same plants to build it. So that's why they're in the position they're in. Now, geopolitically, they're a communist country. They're a dictatorship, essentially. And they are resource rich. The resource being labor and other metals, rare earth metals, which are all EV related. So they are in a significant superior position to us right now. I don't think that'll last very long, but I don't think the current administration has the tools to figure out how to deal with them. And again, have you ever seen a Huawei phone?
Yes.
And I kind of laugh. It's an Apple phone. They basically took the Apple design, copied it, called it Huawei, and are manufacturing it. So there's lots of, from a manufacturing and a intellectual property standpoint, they're a nightmare. If you manufacture there, they're going to steal your IP, and there's not much you can do about it. So there is a lot of problems, and again, and they are positioned in a point. But I personally like global deflation. I think that it allows us to all live a better lifestyle, and so I wouldn't want to see that. I would like them to work something out versus becoming extremely protectionist and having all our lifestyles go back down somewhat because goods and services become extremely expensive.
So we shouldn't be too worried about China then? I mean, they're competing, but we should. I
think we should be really worried. I would really worried, but again, they are who they are. They are in. You can't just ignore them. That would be foolish. And so I just think that from a foreign policy standpoint, they might need to rethink things. I wouldn't want us to go to war, or even to think about going to war with them. I think that would be fairly awful.
Right. Well, thank you, Josh. Bob?
So one of the issues that I think is going to come in the future has to do with the dollar as the world's reserve currency. Certainly, China and the Eastern Bloc would like to see something else besides the dollar being the reserve currency. As the reserve currency, there's a lot of benefits that our economy gets, because anybody in the rest of the world wanting to do trade usually has to convert first into dollars. And that means the demand for the dollar is really high, and all of the benefits that brings to us. So what's happened here in the last year is that we have this Fed that seems to be a rogue Fed. I'll just call it that. They pushed interest rates up maybe too fast, and they've caused big issues in the rest of the world. In the foreign exchange markets, for example, Japan's yen, which was like $130 to the dollar back in March, is now 150, and they've had to intervene in the foreign exchange markets to keep it even at 150. And the same with the pound. The pound was over $1.20, and at one point it was $1.03. And so they've had to intervene. And in Great Britain, the big rise and the fast rise in interest rates caused their pension funds to have big liquidity problems, and the Bank of England had to intervene in the markets and give them a lifeline. Otherwise, they would have gone bankrupt. So the rogue Fed has caused these big international issues, and I think that the central bankers are going to get together and say, why is it that the world's reserve currency is based upon one central bank? Now, we've had this discussion 20 years ago. What should be the reserve currency? And there was a discussion of it's some kind of a basket of different currencies, et cetera. Anyway, the point here is I think this is going to be revived after this episode that we've had with this Fed. And it's going to be revived. And now we have China and the Eastern Bloc probably actively saying, yes, let's revive it. Let's get a different reserve currency.
Yeah.
And if that happens, it's going to be an issue for our economy. And we won't be able to grow as fast, et cetera. And we won't have the quote unquote the privileges that we've had as the reserve currency. So I think that that's a big issue that's coming.
Good.
And let me add to that.
Sure.
Essentially, we kicked Russia off the SWIFT system. And so they came up with a new system. Now, why is SWIFT important? That's how international banks settle checks between each other. And so the fact that they created another electronic system for international banks when the SWIFT system was in play for years and years and years is a suggestion that they're walking down this line. The idea that they're creating another commodity exchange in China as well. I mean, these are the things that you need to have some reserve currency status. So things are set in motion to walk away from the dollar as the reserve currency. And how long will that take? Your guess is as good as mine.
Yeah, but a lot of issues to consider. Let's hope America can pull this off and keep the reserve currency status, and we come out of our inflation mess and go back to a strong economy. There's a lot of issues, guys, and I really appreciate your insight on all this today. And I think we're going to leave it there. Let's hopefully do another check-in with you guys in the first quarter and see what comes up then. We really appreciate your being with us today on the FourStar Today's Market Explained podcast.
Thank you.
Enjoy being here.
Coming. Thanks, Jack. Thanks, Bob. Thanks, Josh.
Thanks,
and we'll leave it there, everybody, and look forward to another great episode here very shortly on, again, Today's Market Explained podcast, a FourStar Media enterprise. Take care, everybody.